Hi, my name's John Baynham, and I'm an award-winning financial planner and president of Retirement Income Group. And I'm here with Rob Taylor, the Chief Investment Officer at Canoe Financial. And Rob, maybe tell us a little bit about yourself and your experience and what you do for Canoe.
Yeah, so I'm the Chief Investment Officer, but also Portfolio Manager. I manage about $4.5 billion of assets. At the company, I focus on North American equities. We're active managers, so we're stock pickers. That's kind of really what our strategies are geared towards.
The main question on everybody's mind today, it seems to be, is inflation. Over the pandemic, central banks, the Federal Reserve was telling us that inflation was transitory, and we just had a record inflation print recently. So, what are your thoughts on inflation? Are you still thinking it's transitory? What are your thoughts on inflation and where we're heading from here? And maybe how are you positioning your portfolios?
Yeah, I think a year ago, a lot of people thought that inflation that we were seeing would have been transient and the market was treating it that way. But I think there are some structural factors at play here that could mean that some of the inflation that we're seeing is going to, level out at a higher level than we saw in the past decade. There's things like we're seeing global conflict everywhere. And I don't think that's going away anytime soon. We're seeing this trend in deglobalization. I mean, the past 20, 30 years, we've seen a trend to globalization, but if there's barriers going up around the world, I think you could see more deglobalization, which is an inflationary. I think what you saw with COVID was there were issues with supply chains everywhere. And now companies are rethinking about where they want their supply chains. Do I need more suppliers? Do I want my supply chain in areas like China or in Asia? Or do I need to start thinking about bringing them back to North America? So there's a reshoring trend, which means that the input costs into some of the products that we consume are going to be higher going forward. The gap between the wealthy and rich has never been wider. And I think we're going to go from wealth creation to wealth distribution, meaning that some of that wealth that is in the higher income brackets is going to start to get redistributed to lower incomes going forward. And finally, wages. I mean, wages, there are more job opportunities out there right now than there are actually people to fill those jobs. And I think a lot of
the labor market's really hot.
Yeah, a lot of those workers that that worked in these real economy jobs went away with COVID. A lot of them are retired, and now there's a skills shortage that we need to fill. And I think the only way to fill some of those jobs is to hire people at higher wages and higher incomes. So I think there's upward pressure on there. And then there's an energy crisis that where we've been underinvesting in supply for the better part of a decade. And now we're short supply as demand is continuing to grow. So I think that's also putting further pressure on inflation.
Well, yeah, those are some good points. So maybe just to sum up, people thought that inflation was going to be transitory at first. Maybe there's a lot of like used car prices and things that we saw in the news. But today we're seeing, substantial wage growth, energy. Everyone knows about what's going on in Russia and the impact that's having on energy markets, structural underinvestment. And so these things, while inflation will, maybe come down from where we're at today, it's probably going to level out, much higher than it was from post-financial crisis.
I think that's our view. Like, we're not in the camp that you're going to continue to compound inflation at 8 or 9%. It's going to naturally, the year-over-year comparisons are going to get more difficult here. Right. But are we going back to 2% inflation? And I think that's what we think is going to be, something the market's going to need to consider over the next decade. If we level out at 3 or 3.5% inflation, well, that's going to be a very different environment for the Federal Reserve. I mean, the Federal Reserve systorically has been able to kind of back off. There's always been this Fed put in place in the market, but that was in a disinflationary, low inflation environment. If we're in a higher inflation environment here going forward, it's going to be sustained above, let's say, 3%. Then it's going to be difficult for the Fed to walk away, which could, is going to have implications on the market.
Okay, and I think that leads us into our next question with the change in maybe over the last decade, part to what you said about, deflation and, central banks printing money, and we had like really low inflation over the, past decade. going forward, or we've already seen it, is this kind of rotation from like super growthy names, like the FANG stocks and things like that, into more of a value trend, which you've done really well with over the past, at least over the past year. So what do you see going forward? Is that like something that's going to be more structural or longer term, or is this kind of like a quick fad that's going to revert back to seeing those like high growth tech names with leadership?
Yeah, I mean, I think that we've been in a 40-year bond bull market. Rates peaked out in the 1980s and been falling ever since. And during that period of time, I think it's something like 30 of 38 years growth has outperformed value, and if that falling interest rate environment, that disinflationary period that we've been in. If we're going to see the mirror image of that going forward, where inflation is structurally going to pick up, the bond bull market's over, we're at the beginning of a bond bear, which means rates are going to trend higher going forward. I think that value is most likely going to outperform growth going forward. And we've looked back at this. I mean, unfortunately, over the past 40 years, you'd have to go back 40 years earlier than that, back to the 1940 to 1980 period, to see the last time we were in a bond bear market.
Yeah.
And if you look at that period of time, it's the mirror image of what we've seen over the past 40 years, where value would have outperformed growth for the majority of the time during that bond bear market.
So so basically, like as real rates are rising and bond rates are rising, that's a prime time for value to outperform growth, essentially. So if that's something that structurally we're going to see going forward, it's
and you can look at the 1970s. I mean, the 1970s was the last time we saw real rates as negative as what they were most recently. And if you looked at what happened to the valuations of stocks in the stock market during the 1970s, as rates went from extremely negative to positive, the valuation multiple, the markets contracted significantly. And, there was this group of stocks called the Nifty 50 back then. They were this high quality group of stocks, similar to some of the high quality stocks that dominate the S&P 500 right now. They traded 40, 60 times PE multiples. But as you went into the 1970s and real rates went from negative to positive, the multiples on those stocks contracted significantly, and the broader market multiple got cut in half. So that was a lost decade for stocks, because the valuation or multiple contraction offset the earnings growth of a lot of these businesses.
Right, and then just for people, like, so price earnings is how much you would pay for earnings of a company, right? The stock price to the earnings that a company actually makes. Just saying, like, even a company could still be growing its earnings, but because interest rates are going up, we're in this kind of new environment, the amount you would pay for the same, maybe dollars of earnings would be less in this situation. And, the last time we had that, there's like a lost decade for stocks. So, what do people do? Like, how do you combat that in terms of, like, where do you find growth and opportunities in an environment like this?
Yeah, in an inflationary environment, you tend to want to be in hard assets and the real economy. So if you think of what really did well over the past decade during this deflationary environment, falling interest rate environment that we were in, it was more of the paper assets, and that was the multiple expansion that we saw in a lot of stock markets globally. That, at the end of 2021, as we entered 2022, we were sort of at the high end of historical in terms of valuation ranges. But in a period where, rates are rising and inflationary pressures are building, you want to be in those real economy assets, those things like, commodities. I happen to believe there's a big CapEx cycle that's on the come here. That's going to be needed to rectify some of the supply issues that we have globally. So I think it's kind of like the old economy versus the new economy that maybe is going to be the areas that outperform here going forward.
So you mentioned a few really interesting things about kind of hard assets, commodities, energy. Do you maybe expand about that a little bit? You mentioned you're seeing maybe a big push or a lot of capital flowing into that space to invest because it's been underinvested in a long time. We don't have the infrastructure, for liquid natural gas or oil. That's a big conversation right now because we can't really, help our friends in Europe. So what do you see going on in that space, kind of in commodities, harder assets, energy?
I think in the past decade, you've seen massive underinvestment in that area. and we're at the beginning of a cycle that I think is going to last like several years. So, there's a real opportunity, I think, in that space. And I think what's interesting right now with respect to the stocks are cheap, right? I think a lot of the market is having an issue right now with understanding with what we're seeing in the commodity markets, if it's sustainable or not. And when the market finally gets to the point where it believes that what's going on is actually sustainable, like sustained higher prices going forward, that will get reflected in the stock prices. So I think that there's a real opportunity in the commodity sector, and this isn't over until we see a CapEx cycle. And what you're seeing right now in the sector is companies are generating a lot of cash flow, they're deleveraging their balance sheets, they're buying back their stock, they're paying out big dividends and special dividends to investors at the moment, but they're not putting the money into the ground. And you're not going to rectify the supply shortages that we're seeing until you see that CapEx cycle. So until that happens, the cycle keeps going, in my view, and you want to buy the dips. It's still early. I think we're in the third or fourth inning of the commodity cycle. I'm not saying it's going to go up in a straight line and nothing ever does, right? Like, there's going to be puts and takes along the way, and we're going to get corrections from really overbought levels. That's going to set up for some really good opportunities when you look out over the next several years.
Right. So even though, the U.S. just, released a bunch of barrels from the Strategic Petroleum Reserve and things like that, this is something you think is going to last a few years. And, maybe this is an opportunity to pick up some more oil names or, kind of commodities in general due to a lot of this underinvestment.
Yeah. And I think, some of these things that you're doing, like releasing barrels from the Strategic Reserve, like that's a Band-Aid solution. That's not going to solve the issue, which is that we need to find ways of putting more capital into the ground until, some of these other areas like electrification, et cetera, or there's probably needs to be more innovation on that front to really impact the demand side. We're not seeing, and like, if anything, demand continues to grow here. So we're not seeing, what's going to be necessary to end the bull market in commodities at the moment. And that's why I still am very confident we're in the early innings. Okay,
that's great. And what about maybe some other hard assets? I know you mentioned kind of energy, commodities. As real rates are changing, are there other hard assets that you look for in the portfolios, or is it mostly energy?
I think like anything I think the story on the whole resource space is very similar, that it's been a period of underinvestment, and in order to rectify supply shortages going forward, I think you're going to need to see more investment in general in the sector. I mean, other areas, hard asset areas that tend to do well in an inflationary period would be real estate.
Right.
So there might be some areas within the real estate space that tend to be protective in more of an inflationary environment.
So as we were coming in here, you were mentioning to me that, you think it might be a difficult period for index investors. So do you maybe want to elaborate on that idea? Maybe like, why has indexing done so well over the past, couple decades? And what does the, this kind of area of investing look like going forward?
Right. So, secular bull markets in stocks tend to be very good for index investors. And by the end, what tends to happen is you start to see a crowding into the most popular stocks in the index, which I think is what we're seeing today, where if you look at the index, I think 32% of the top 10 names are located in the top 10 names in the market right now. So it's been a fantastic environment to be an index investor. You've been compounding returns at double digits for the past decade. I think, unfortunately, with valuations where they are, and if we're at the beginning of a bond bear market where rates are going to start to trend higher going forward, that what you tend to see is multiples compress. So there's less meat on the bone in terms of the returns that you're going to generate in the broader market going forward. So that means that you need to be a stock picker. You're not going to get the beta, like a rising tide lifting all boats. You need to be very specific about the stocks that you're gonna own, and you want to generate alpha in the portfolio. So that's really what we're geared to doing in terms of our strategies, and I think that's sort of the winning strategy that you're going to see going forward. And these things cycle over time. I mean, there's decades where you want to be a passive investor, where it's just a trending market. and those index weights get bigger and bigger and bigger, and then you see major shifts in the market, and those big index weights start to dissipate as the average stock in the stock market kind of catches up. And so you see the breadth starting to expand into other areas of the market. And I think that's what we're at the beginning of right now.
Okay, so I mean, like right now, a lot of indexes, everyone hears about the FANG stocks, right? You know, the Facebooks, Amazons of the world. So, you know, indexes are very overweight these few stocks. What you're saying is, you know, it's time for other areas of the market to outperform, and this will actually maybe weigh on indexes as kind of those big, you know, big few names, you know, draw down and everything else kind of comes back up.
And different leaders start to emerge, right? I mean, there was a period where ExxonMobil would have been the biggest stock in the S&P 500, and it's fallen out of the top 10. But, you know, these things cycle, they mean revert over time. Different leaders, like every decade is a bit different, right? So we've told investors you can't use last decade's playbook for this coming decade because it's probably the wrong playbook that you're going to be using.
Yeah, that's great. So, you know, maybe we could talk a little bit about, you know, what do you actually do for Canoe, right? Specifically, I mean, you run, you know, 6 mandates. You know, how are you finding these companies? How are you different from, you know, from the index or from the average, you know, kind of stock picker out there? Because you've done really well. I mean, we don't usually talk about returns in these videos, but I mean, you've substantially outperformed the index over the last year. So, like, kind of what makes you different from the average?
Yeah, I think there's a few things. I think first of all, you can't beat the market if you look like the market. So we look very different than the stock market. So we have what's called high active share. So if you looked at our holdings and our portfolio, they would look very different than the index holdings. We're stock pickers. I mean, we don't mind being off benchmark if we see good risk reward in individual opportunities. And in fact, you know, everything that we do is really geared towards, we want to find a certain quality of business that we're comfortable with, that fits in with our philosophy of investing. And our style is more buying companies that have been out of favor for a period of time that we think they're going to outperform going forward. There's some sort of catalyst that will re-rate and the stock will mean revert back to its historical norm. Okay. And so I think it's that mean reversion being kind of zigging while the market might be zagging, and really thinking about where the puck's going to go instead of, you know, looking directly at what's performing best right now. That's led to the success that we've had in the portfolio.
Yeah, that's great. And then are there any other, you know, maybe metrics that you look for on a, you know, for a company?
Yeah, so we always say we like quality businesses with a value tilt. I mean, we're not gonna pay any price for a business. So, you know, we like high ROE, high margin, good free cash flow characteristics. We like companies with low leverage and companies that can internally finance their growth. I mean, those are all really important characteristics to us. The free cash flow is extremely important. I think the environment that we're going into going forward, it's going to be important to have shorter duration free cash flowing companies, because as rates start to move higher, so does the discount rate that you discount those future cash flows back at. Right. So having distant cash flows, let's say a company that's generating cash flow in 2030 or 2040, discounting that back today at a high discount rate, it's going to be worth a lot less, versus a company that's generating cash flow today, that's worth a lot more. So we want to find businesses that generate cash flow today, which means high free cash flowing businesses and shorter duration cash flows.
Yeah, that's great. And then, yeah, so maybe just to sum up, it's like you're focused on, you know, whereas maybe on the last decade as interest rates were going down or like, you know, really low, it's the businesses who had these like future cash flows that hadn't yet been realized were doing really well in the market, you know, but now, I mean, those businesses might still be great businesses, but the market's going to tilt and the stock prices is going to favor the companies that have cash flows today. Right. You know, companies that make money today and have a lot of cash flows. And that's where your area of expertise is and where you're focusing on.
Yeah, I think that's what's going to do very well going forward.
Yeah, thank you all so much for watching. If you have any other questions, you know, please reach out to myself or Evan and we can tell you more about, you know, Rob and Canoe and what they do. If you like this video, please click the button to subscribe. Or sign up for our newsletter and you'll get it emailed right to your inbox.